Are you ready to discover the secret sauce to building a lifetime of passive income? Well, here's a question for you. What if I told you there's a man who, for the past 58 years, has been running circles around Wall Street, overseeing an astounding aggregate gain of more than 4,300,000% in his company's Class A shares? Yes, you heard that right. I'm talking about none other than the legendary Berkshire Hathaway CEO, Warren Buffett. As of the closing bell on August 18, 2023, he's not only achieved this remarkable feat, but has also doubled up the broad-based S&P 500 since becoming CEO, based on annualized total return as of December 31st, 2022. But what's the secret behind Warren Buffett's incredible long-term success? Well, one undeniable factor is this penchant for investing in dividend stocks. You see, public companies that pay regular dividends are often time-tested, possess clear long-term growth outlooks, and most importantly, are consistently profitable. In other words, they're businesses that investors can trust over extended periods. Based on Berkshire Hathaway's most recent Form 13F filing, the Oracle of Omaha and his investment team will oversee the collection of more than $6 billion in dividend income over the next 12 months. And here's the amazing part. A whopping $4.31 billion in annual dividend income will be just from 5 stocks. That's the power of Warren Buffett's dividend stock strategy. And in this video, we're going to dive deep into the Warren Buffett 7 best stocks to hold for a lifetime of passive income. So let's get into it. Number 1, Visa. When it comes to stocks for a lifetime of passive income, Visa stands out as a true heavyweight. Visa's dominance in the world of digital payments is unrivaled. With more than 3.2 billion Visa-branded cards circulating globally, it's a name that's synonymous with convenience and security in electronic transactions. As the world gradually shifts away from cash and checks in favor of electronic payment methods, Visa stands to benefit immensely from this ongoing digital payment revolution. The company is well positioned to capitalize on this global trend, given its extensive network and trusted brand. With an estimated market opportunity of approximately $225 trillion in payment flows, Visa's growth potential remains substantial. One of its most compelling aspects of Visa's investment appeal is its consistent and remarkable dividend growth, boasting annual increases exceeding 20%. Visa's dividend growth isn't just impressive, it's exceptional. While the current dividend yield may appear modest at around 0.7%, it's important to recognize that this figure reflects Visa's stock price appreciation rather than any shortcomings in its dividend policies. In terms of consistent dividend delivery, Visa excels, making it an ideal choice for those constructing a portfolio geared towards long-term passive income. Number 2, Mastercard. Mastercard holds a prominent position in the digital payment industry, serving as a global leader in electronic payments. Berkshire Hathaway's recognition of this potential is evident in its stake in Mastercard, with a market value of $192.7 billion. Mastercard's presence is felt across the world, offering innovative solutions that facilitate seamless electronic transactions. One of Mastercard's most impressive attributes is its stock price growth, having witnessed a remarkable 96% increase over the past 5 years. This growth showcases Mastercard's potential for long-term success in an era where electronic payments are becoming more prevalent. While Mastercard's dividend yield may appear modest at 0.5%, it's essential to recognize that this figure doesn't tell the whole story. The company has consistently demonstrated a commitment to returning value to its shareholders. This low dividend yield is largely a result of Mastercard's exceptional stock price growth. Number 3, JPMorgan Chase. Even the Oracle of Omaha, Warren Buffett, has his moments of regret, and one such instance revolves around JPMorgan Chase. Buffett openly expressed his remorse for not investing more in JPMorgan, recognizing the importance of steady earnings and ample cash reserves in the world of investing. JPMorgan Chase boasts several strengths that have caught the attention of investors, including positive earnings revisions. The stock has witnessed a substantial 15% increase, outperforming the industry's growth. Looking ahead, JPMorgan Chase has outlined strategic expansion plans both domestically and internationally. The company's efforts to diversify its revenue streams and maintain a strong balance sheet have not gone unnoticed. In fact, JPMorgan intends to increase its dividend by 5% to $1.05 per share, accompanied by a share repurchase program. When it comes to passive income, dividend rates play a crucial role, and JPMorgan Chase doesn't disappoint. While many investors may chase high-yield dividend stocks, it's essential to consider the overall financial health of a company. JPMorgan's current dividend yield of 3.5% might not be groundbreaking, but it's double the 1.6% yield of the S&P 500, making it highly competitive among large-cap companies. With a forward P/E ratio of just 9, JPMorgan Chase presents an appealing opportunity for dividend investors. Number 4, HP. Hewlett-Packard. When it comes to tech stocks, Warren Buffett is known for his cautious approach, making HP a particularly intriguing choice on his list of top stocks for a lifetime of passive income. Buffett rarely ventures into the tech sector, making his investment in HP all the more notable. Berkshire Hathaway, under Buffett's guidance, holds a substantial stake in HP, indicating the company's unique appeal. HP stands out not only for its technology focus, but also for its impressive dividend track record. The company has consistently increased its dividends for an impressive 13 consecutive years, showcasing a commitment to delivering value to shareholders. With a healthy dividend yield of 3.5%, HP offers an above-average income stream compared to many other tech stocks. HP's ability to maintain and grow its dividends is underpinned by several factors. First and foremost, the company is diligent in managing its debt-to-profit ratio, ensuring a healthy balance sheet. Secondly, HP actively implements cost reduction strategies to maintain ample cash flow for both growth and dividend payouts. Moreover, HP strategically invests in areas with long-term potential, such as remote work solutions and subscription-based printing services, aligning itself with the evolving tech landscape. As the company continues to improve, HP's printing and consumer PC businesses are expected to rebound. Number 5. United Parcel Service. UPS plays a crucial role as an economic bellwether, serving as a barometer for economic activity. Its vast package delivery, shipping, and logistics operations make it a vital player in several industries. For dividend investors, UPS's track record is impressive, having raised its dividend for 14 consecutive years. For income-focused investors, UPS offers an attractive dividend yield of 3.5%, which is double the yield of the S&P 500 index. This competitive dividend yield, coupled with UPS's reputation for reliability, makes it a compelling choice for those seeking stable income. UPS has also approved a substantial $5 billion share repurchase program for 2023, further demonstrating its commitment to returning value to shareholders. Number 6. Occidental Petroleum. Berkshire Hathaway's investment in Occidental is no small feat, as the conglomerate holds a substantial interest in the company. In fact, Berkshire's stake in Occidental surged to over 20% during a time of significant market volatility, including Russia's invasion of Ukraine. This investment move propelled Occidental's stock up to an impressive 91% rise over the past. The fact that Warren Buffett, known for his prudent and value-driven investment strategies, has chosen to back Occidental speaks volumes about the company's potential to deliver consistent passive income over the long term. Occidental Petroleum distinguished itself in the energy sector through its highly efficient drilling practices. Often shining like a multitude of stars, the company's drilling methods are renowned for their effectiveness. Despite owning less than 5% of the total Permian Basin wells, Occidental impressively held around 23% of the best-performing wells during its acquisition of Anadarko. Furthermore, Occidental is at the forefront of the sustainable energy practices, making substantial commitments to low-carbon technologies. Number 7. Johnson & Johnson. Warren Buffett's investment choices are often closely watched by investors around the world. What makes Johnson & Johnson a standout pick in his portfolio is his unusual interest in healthcare stocks. Historically, Buffett has not ventured much into the healthcare sector, making J&J a surprising one. One of the most compelling reasons why Johnson & Johnson stands out is its exceptional dividend history. J&J has a streak of over 6 decades of annual dividend increases, making it a reliable and dependable source of income for consecutive investors. Its commitment to returning value to shareholders is evident through its consistent dividend growth over the years. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.